Hello everyone, welcome to our new video in finance course. So we continue with chapter 4 today, analysis of financial statements. And here, first question is basically, can we make money analyzing stocks? It's an important debate in finance, and some studies or some academics argue that the stock market is highly efficient and all available information regarding a stock is already reflected in its market price. So if we consider from this aspect, the efficient market advocates point out that there are thousands of smart, well-trained people, analysts working in the industry, and therefore, as a result of this highly competitive market, basically all the information is already reflected in the existing market prices, and it's not possible to consistently outperform the market by utilizing various trading strategies that uses the past information. So one of the other key concepts is the so-called value investing. And as you all know, Warren Buffett, one of the world's best-known investors, and he has established the company Berkshire, and he has made, of course, significant investments throughout his investment career into well-known companies, including Coca-Cola, American Express, etc. And he follows the so-called value investing approach, which basically looks for stocks trading at prices that are below their intrinsic or estimated intrinsic values. So here, if you can basically find a relatively cheap, undervalued stock in the market, and then wait for the market price to basically catch up with the intrinsic value, then you will be basically making the profit from this investment. So value investors basically rely heavily on the type of analysis described in this chapter and considers the fundamentals of the corporation, including their balance sheets, income statements, financial statements, and financial ratios. So in some sense, utilizing this available information, we are trying to find temporarily, let's say, undervalued stocks in the market. Of course, as we mentioned, the efficient market hypothesis, on the other hand, claims that already, all the available information, including, of course, the financial statements, are already reflected in the market prices. Okay. However, the value investing approach might work if you have, if you can identify such stocks more, let's say, successfully than other investors, basically. So the ratio analysis that we will talk about in this part includes a variety of categories, and we might look at two liquidity ratios, which gives an idea about the firm's ability to pay off debts, okay, that are within a year. And then we will have some asset management ratios. These type of ratios gives us an idea about the efficiency of the firm utilizing these assets. Okay, for example, a company might have lots of assets, but its sales might be relatively small compared to the size of its assets. Okay, and we can look at to the industry average to see the efficiency of this company compared to its industry competitors. Okay, so this would give us an idea about the efficiency, how efficiently we are utilizing all these assets in terms of reflecting sales numbers. And then we have the debt management ratios, and these give an idea about how the firm has financed its assets as well as the firm's ability to repay its long-term debt. And we will talk about, of course, profitability ratios. Obviously, you want the company to be as profitable as possible, and this type of ratios give us an idea about the profitability of the firm from its operations and utilizing its assets. And then finally, market value ratios, which are about the firm and its future prospects. And this will be reflecting the investors' perception, what investors actually believe about the company's future. So now the liquid asset, what's a liquid asset? Because we are talking about the liquidity ratio as the first one. A liquid asset means that can be converted to cash quickly without having to reduce the asset's price very much. Okay, so the cash itself is the most liquid asset, first of all, because cash, is already cash and it can be spent with its exactly the same nominal value. And there might be some other assets that are also very close to cash. You might be holding, for example, gold or silver or this kind of assets. These are also highly liquid, of course. You can just convert them to a different currency anytime by paying as a relatively small transaction fee. And then the liquidity ratios, these ratios, as we mentioned, show the relationship of a firm's cash and other current assets to its current liabilities. So the current ratio is the first one. So basically it's the ratio of current assets divided by current liabilities. So it is easy to remember. Current assets divided by current liabilities. And what are the current assets then? They include cash, marketable securities, accounts receivable from our balance sheet, as we remember, and inventories. So these are from our balance sheet. And then the current liabilities, basically these are the obligations of the firm to pay to other parties within 1 year. Okay, this should be due within 1 year. Then this is part of the current liabilities, and some examples like accounts payable, accrued wages and taxes, and short-term notes payable to its bank. So these are all liabilities of the company, and they show up in the balance sheet. So as you see now, the formula, mathematical formula, you have the current assets. This should be, we already mentioned that these are some examples of current assets, and this can be directly found in the balance sheet of the company. So once you find this number, then you will divide it by the current liabilities, and this will give you a ratio. For example, here we get 3.2. On the other hand, the industry average for this corporation, for this example, is 4.2. Okay, so our corporation in this example has a lower current ratio than the industry average. Okay, so in other words, the company that we are talking about in this example is less liquid compared to the industry. Okay, because the higher this ratio, the more liquid is the company. It's a liquidity ratio, as we mentioned. So it is below the industry average. Of course, this is the hypothetical number here. Okay, we are just considering this as an example. And from the balance sheet that we used in the Allied's example, we considered in the previous videos as well, the same example, looking to the balance sheet, we can fill in these numbers. And important thing is here, this gives us a number below the industry average. So as an investor, we can see that this corporation, the liquidity is relatively lower than the industry average. Okay, another one is the asset management ratios. A set of ratios that measure how effectively a firm is managing its assets. As we said, a corporation might have a lot of, it might be having too many assets, but if the sales are much lower than this size of the assets, then if this, especially if this ratio is lower than the industry competitors, that means the company is not using its assets very effectively. Okay, and another one is inventory turnover ratio. This ratio is calculated by dividing the sales by inventories. Here is the inventory turnover ratio calculation. Sales number for this company, the sales is given as 3,000, but this is in millions. So this means $3 billion of USD. $3 billion US dollars is the sales figure we have shown in the previous, again, income statement. You can check this. And then inventories were also given on the balance sheet. So we can fill this number from the balance sheet. And this gives us 4.9. Suppose the industry average is 10.9. So that means the inventory turnover ratio for this corporation is lower. In other words, the size of the sales relative to the inventory is low. In other words, again, this corporation is actually keeping a high inventory relative to its sales numbers, okay, which is not good for the efficiency. From the efficiency perspective, of course, everything else being the same, constant, the inventory turnover ratio, it is lower than the industry average, which indicates some efficiency loss, some loss of efficiency compared to its competitors potentially. Okay. Another one is the fixed assets turnover ratio. This ratio of sales to net fixed assets, and here we can see the formula. Fixed assets turnover ratio is obtained by dividing the sales number by the net fixed assets. So this is also a reflection of the efficiency for this corporation, because we want this number to be as high as possible. I mean, at least above the industry average, to say that these fixed assets are efficiently utilized. Okay, if this number is higher than the industry average, this is the case for this corporation, so it's a good signal. At least it tells us that the assets are utilized effectively, or at least more effectively than the industry average. Okay, another ratio we want to mention is the total assets turnover ratio. So what about this one? Again, it's a simple, or it's a similar, let's say, ratio, where this number is obtained by dividing the sales with the total assets. Remember, the total assets from the balance sheet, the sales number is from the income statement. So if you just look at to the balance sheet and income statement, these numbers are just written there, and we just fill in the values. 3 billion divided by 2 billion, that gives us 1.5, and that shows us that industry average is higher. So this corporation is actually utilizing these assets less efficiently compared to the industry average, because this number, the higher, it indicates a more efficient use of total assets. In the previous ratio, remember, we have utilized the net fixed assets. This is for fixed assets. So this one is showing us the efficiency of how the fixed assets are used. But here we are looking now the total, all the assets together, okay? And we are reflecting how efficiently is all the total of our assets are utilized. So this is broader in this sense. It includes all our assets, but the previous ratio here just focuses on the fixed assets. And as you know, the fixed assets include, for example, the production plant, the equipment, or some vehicles, etc. Okay, so we will talk about one more debt management ratios, and we will complete this video, the first part of this chapter. So for the debt management ratios, these type of ratios measure how effectively a firm manages its debt. Again, this is important because pretty much many corporations borrow money, they have debt, and it is important to make sure for investors should make sure that the company uses this debt effectively. And as you now notice in this table, we have actually two cases. The first case, let's say, is the so-called unleveraged. So if the company don't have any debt, okay, no debt, so that is 0. The common equity part is 100, let's say. So total liabilities and equity, summing 0 plus 100, we get the total as 100. So now let's look at this problem, whether the company having some debt and common equity, let's say 50-50 versus 0-100. So what would be the difference of these two cases, whether the company is fully financed by common equity versus half debt and half common equity? Okay, what will be the difference between these two types of companies? So as you see, the current assets are the same, fixed assets are the same, total assets are the same. So we are keeping pretty much the same everything, except there will be some major difference here. In the sales revenues, we have operating costs, we have the fixed and we have the variable operating cost. So here the fixed cost, as you see, we separate according to the state of the economy, and we have the good scenario, the expected, let's say, normal case, and the bad scenario of the economy. So depending on the conditions in the economy, our sales revenues are given as 150, 175. This is the same for both corporations. Okay, so this part is the same for both corporations. So we have these scenarios, and then now we have the operating income after the total operating cost is calculated and subtracted from 150. Subtract this part, you get the $45 million. Okay, these are in millions. So here we have 100 minus 85, so you get 15. 75 minus 75, you get 0. So now the part that is different is here. If the company has some debt financing, I mean 50-50 here, then there will be some interest payments, okay, for this 50 million of debt. And that will correspond from 10% times 50. That gives you this minus $5 million. Basically, that's the interest rate cost. So from the operating income, if we subtract the interest rate, as you see, you will get 40 million, 10 million, and minus $5 million. And also calculating the tax, 40% of this number. So if you multiply 40 by 0.4, you get 16 million as tax. 40% of 10, you get 4 million, and this is minus, so the tax will be 0. And then finally you can calculate the net income for this company with some debt and common equity. So now what's the return on equity here? The return on equity is obtained by dividing this $24 million with the common equity of 50. So basically, if you divide 24 by 50, that gives us 48% return on equity for the good scenario. For the expected scenario, you have this net income is 6. So if we divide 6 by 50, we get 12% here. This is the return on equity in the normal case. And finally, this one, minus 5 divided by 50 is minus 10%. Okay, so that gives you the minus 10% here. So if we have 50 million debt and 50 million common equity, the return on equity is given like this. But for the first case, as you see, it is 100%, 100 million completely from the common equity and 0 debt. So since there is no debt, basically the interest expense here is always 0, okay, because we didn't borrow any money. So this is 0. And the return on equity now is going to be the net income, which is 27, divided by the size. Return on equity is now just 100. Okay, so this gives you 27%, or this is 9 divided by 100, it is 9%. And this is 0, so 0 divided by 100, that is also 0. So as you see, if the company has no debt, this is the unleveraged case, okay, because the company has no leverage, it is unleveraged, and therefore the return on equity is actually it's actually not too large, it's also not too low, right? It is in a narrow band, it's in a narrow range of values compared to the second case where we have some leverage, okay, and that means we have some debt. And assuming that the total common equity is 50 now, so now we have 50 plus 50, again we have this total $100 million, okay. But now the change becomes there is some interest payments now because of this debt is from 10% interest. So we have some expense for paying the interest for 50 million. But on the other hand, as you see, the return on equity is potentially much higher than the previous case. But on the contrary, the disadvantage here is that we can also have a much bigger loss. In the other case, the loss is limited to 0, but here it can be up to 10% loss under the same scenario. So as you see, it matters whether the corporation is leveraged or not. and we can directly observe that the effect of the leverage is reflected, right? Originally we have no leverage and the return is from 0 to 27, but now from -10 to 48. So potentially, yes, we can get much higher return on equity. However, we can also have a bigger loss. So that's the trade-off you should keep in mind when you are comparing two companies with some leverage or unleveraged cases. Okay, we need to keep this in mind and understand what's the difference on our basically return on equity in both of these cases. Okay, so let's stop this video here and we will continue next time. Thank you.